Sanjay, welcome. Thank you so much for joining us. How are you?
Pretty well, Simon. Thanks for inviting on the show. It will be my pleasure to talk to you after a long period.
I really appreciate it. Yeah. Well, look. First of all, I want to ask you, how are things in India, and how are things with coronavirus? Is everyone okay?
Things are looking better with government stepping into it. While I can't say that we are through the stage 2 or 3 kind of stuff, but yes, we looking at the population and the demographics. Government is trying hard to ensure that it does not go really big in a viral way. So we have put all stops, and hopefully things should be back into normal mode in a week or two time. That's our hope.
I haven't heard much about what's going on in India, but is there a quarantine system in place? How is it playing out?
Yeah, so we have an isolation centers here. In Mumbai, we have a Navy dock kind of stuff where they've created in quarantine isolation centers for the patients, and that's where we have got infections of around touching to around 200 of it, and which are quarantined over there. And enough and more tests are being done across India at various levels, and we have stopped incoming flights into India starting Monday. And the cities have been ordered shut down, shops are shut down, no more restaurants, no more shopping, no holidays. So people were taking it very lightly. We had our Prime Minister addressing yesterday evening in terms of do's and don'ts, and we have a self-imposed curfew now coming up on Sunday for 14 hours. Trying to break the chain. Let's hope we break this, and because we are a populous country, so the damage can be very high.
Totally. Well, look, I want to thank you for joining us at this hard time. The purpose of this podcast today, a lot of people out there are sitting at home, they're worried. I want to take their minds off that, and I want to talk about what they could be doing in the future. And one of those things that I always think is a good thing to do in the future is build a business of your own. Equally, perhaps there's people out there that are going to sit down and reflect on their existing businesses, and when we come out the other end of this coronavirus, they're going to want to raise money, or they're going to want to get help to scale their business. So I thought it would be wonderful to talk to a prominent, respected VC like yourself to understand what you're looking for when you're investing in startups, and maybe share some of your knowledge with our audience that are sitting at home today worried, but we want to give them something to think about in the future. So maybe I can start off by asking you, what do you look for when you're investing in a founder, in a company?
So whenever we are looking at a startup, I'll give you our investment thesis, but let me try and make you just understand where we come from. We invest in early stage startups, first checks. So our outlook in evaluation is much different than a later stage VC would be. So we have got 6 parameters on which we evaluate any startup opportunity for investment. One is the market size. If the market size is not large enough, we don't invest into those sectors. We would definitely look into very, very large market size. We would like to see across, if the market size is a little small, is it rapidly growing? If it is growing rapidly, then also that gets our attention. The next comes across is the founder's right to win. So what founders' domain expertise is, why would it be successful, what education does it have, what will it make to be a real unicorn kind of stuff to drive, does it have that irrational perseverance. So all founder traits, typically we would try to assess the founders. The third one will be the business model strength. What kind of business model they have? Is there an ability to make money? How they price the product? What's their go-to market? So everything on the business model side. Fourth comes across as the IP. What kind of IP do they hold? Is it a brand play? Is it a deep tech? Is it a distribution play? what kind of IP or barriers to entry, what moat they can create across, with this stuff. Fifth one would be, in terms of their location, where are they working across? What's their, understanding on the location? So if what geography they are working across, is it online only business? Is it an online offline? Is it going to be only offline? If it is going to be an omni-channel, what ways, what kind of stuff? And do we have an ability to add value in those sector or in that area of operations where they would be working across? And lastly, we will look at, conviction of 20x return. So minimum conviction of 20x return if we do an exit. So those are the 6 points which typically we would look into.
Out of interest for anyone out there looking to raise money, in your experience, from the time you start raising money to the time you've raised the money, how long? And if someone approaches you, how long does it normally take to go through that process you just explained?
So if I have to mention how 100x.vc works across, we invest in a class mode, which means in a batch mode. So in our class 1, we invested into 20 companies in 4 months. And this were the first checks which we wrote. And our investing happens across through iSafe, which is India's simple agreement for future equity. So for us, it's a very quick closure over the counter, less of a legal hassle. It's a standard document, and we have got a fixed check size across. So everything is like a cookie cutter. Once we believe the founder fits our investment thesis, we give them a term sheet. We have a basic due diligence done across on the company's registration, taxes paid, the credit score of the founder, and once the basic DD is done across, we write the check. So that takes around, so from term sheet to check writing takes around 30 days, but once we sign the document, money is transferred in 24 hours.
That's pretty quick. Your experience with founders generally, how long does it take them to raise money, do you think? I think the founders would have to estimate, let's say in their mindset, I always say that, if you believe that you can raise it in 1 month, multiply that by 3, you would be able to raise it in 3. If you believe you can raise it in 3 months, take a year-long time, or 9 months at least it will take. So any estimations what a founder would do across, I would recommend them to multiply it by 3, and that's the basis on which they can earmark their work and go to market to pitch to VCs. And typically, do you lead rounds or follow rounds? What's your take on that side of things?
So at 100x, we lead rounds. We don't do co-investment. So we are the only first institutional VC on the cap table, and we do not do follow-on. So we have an approach where, because we are a feeder to the complete VC ecosystem in India, including a lot of the angel networks who keep looking at our deals kind of stuff. So we have been a complete discovery platform for most of the startups, and VCs, we have a partnership with VCs. So we have got almost 35 plus VCs who have signed up partnership to look at our deal for first look kind of stuff. So we have got first look partnership with those VCs.
How did you get into this business?
So this has been, so I've always been an entrepreneur, a tech entrepreneur. Started with a bespoke software company, built it across. Then .com venture came across in .com times. Built 2 businesses, made a lot of mistakes, failed miserably, lost all my money, fortune, whatever was there. Then built a software product company for SMB, sold it and exited. That was my first formal fortune creation. But it was little, but yes, it was there. And then built an analytics company, which was acquired by a large listed company in India. And that worked out well, and started doing startup. So once my first exit happened, wealth guys pushed me into getting an LP kind of engagement in a private equity fund, and that's where my understanding on this space started on an unlisted companies, and learned across how they operate, what's a model kind of stuff. But being an LP was a very passive, you just read quarterly updates and stuff. So I ended up taking an active role, becoming an individual private investor with angel networks, build friend syndicates. And that's how that whole journey started across. While I was running my analytics company, on the side, started building the portfolio. And after 2015, started doing this like a full-time role.
I'm always thinking about the listeners and what they'd find useful, and so I certainly think your insights in the process of how to raise money is very useful. I also think about the people out there that might want to become an investor. Maybe they're sitting on capital that's getting very low interest rate right now, and they're interested in being an investor. Any tips for anybody out there that might like to become an investor like you?
So, I can always share across my learnings. The way I see across is, private investing in startup as a private investor is a long-term patience game. It's an illiquid asset class. While a lot of people describe this as a risky asset class, I tend to disagree on that. I believe that startup is the only asset class where you can influence an outcome. In rest of the asset class, you will invest into equities, gold, commodities, real estate. You just invest and wait and watch. You can't influence an outcome. In this case, you work with founders, you give the face time, you can actually build an outcome. While it is an illiquid, but that gives away the problem of volatility. You are invested with the company. Companies take 2 to 5 years to build it across. You work with the founders whom you enjoy working across and build that company. And that gratification besides the wealth creation is huge. And so this is not a wealth product, as I mentioned, but this is something if you believe that you can add value, you are an active investor, then private investing works across. If not, then becoming an LP makes more sense, where you can be a passive guy, let the fund manager invest your money in the startup as an asset class. So outcome wise, this is an illiquid, but for high return. So this is like you have to look it across as a portfolio which you are ready to lose all your money. But if given an upside, it should give you outside returns. So this is a very, very interesting asset class, and in the current times, it again proves my theory that equities are more riskier than startups.
Actually, I love that point. I've actually said it myself many times. People always say to me, why have you got involved in not only starting startups, but investing in them? Isn't it risky? And I always say exactly what you say. I actually did invest personally in a lot of stocks. I almost retired at 25. And I put a lot of money into stocks and shares and lost it all because I wasn't in control of what they did in that boardroom. I wasn't able to influence what they decided to do with those stocks, with the company. Whereas when you're an investor, you can influence, you can be a part of their success. You can help steer them away from disaster. You can't stop that from happening when you just own stock and equities, like you say. There's just no influence. So it's a lot less risky, but it's funny how people do see it as so risky, isn't it? I mean, even today, you must get that a lot. Even with your successful track record, people must still say, "Oh, isn't it risky?"
Yeah. So the challenge with the mindset with which most of the investors have been told across is first not to fail. They invest because this company will not fail.
Right.
Whereas as a startup investor, we invest because this company is going to be successful. Failure is part of our success. So it's not about saying that if this company is not if this company will not fail, that's why I'm investing. No, this company is going to be a big success, and that is why I'm investing. It might fail. That's okay. Failures are step towards success. I mean, which most of the investors would have very difficult time understanding, and that is why they believe that startup is an risky asset class. But when you have a good portfolio construction math, so my take is if you do less than 20 startup investment, you are actually buying lotteries. Once you do 20, your capital preservation kicks in. Your capital will be back. Once you cross 20 to 30, you are at 2x, 3x, or 5x. But once you cross 50, then upside is infinite. And my single line goal and to explain most of the time all these investors is your risk is 1x, your upside is infinite. Now that's how you define startups.
It's very, very interesting. Do you think that there's an opportunity? Well, I mean, I read your recent post, which I really enjoyed, which is "Go big, go online." I think that there is this horrible situation that we're in at the moment with coronavirus. I think a lot of businesses are going to be forced to go online. People moving to online. It's not so easy to do everything online. A lot of people struggle. But maybe talk a little bit to your article. What were you trying to say there?
So, going online, going big, the article which I had written about was trying to move the training, online academy, the education side of it, the learning experiences. We have been trained across to a classroom model, and we have seen it is the time, this is the moment where we should be able to change the consumer behavior, where we are able to learn remotely, engage across. Earlier, it was all about saying that you need a physical book to read, and that's how our mind was trained. It took so much time for us to move digitally. Same went across for newspaper, and I believe that education, training, online academy, sharing of experiences, sharing of knowledge, everything needs to go online. There are lots and lots of influencers. I mean, I'm not talking the big guys and the big celebrities, but there are a lot of local influencers. How do you bring them online? How do you get them to create an online academy? So the way Shopify changed the way online retail built across. I invented a software which is called Nourish, which helps building the small SME guys online academies, and that is what I was trying to help the world know, saying that you should be able to go online and build it. It's just a plug and play software, and you start giving your training and monetizing your stuff sitting at home, and other guys gets value while they are anywhere in the world. So it's a business model which needs to evolve and take off.
Look, thank you so much for giving some insights today. I just want to leave with one question. I'm interested in what you perceive as success. What is success to you, Sanjay?
Success to me is me being able to continue investing in Indian startups and building these companies at an early stage, and seeing them grow. And every 100 companies, I'm hoping to have one unicorn in my portfolio. That would be my success for my 100x VC.
Well, I know you're going to get there. You've done some amazing things already, and I'm very grateful you've given time to me and the audience today to share your story and share your insights. So thank you so much, Sanjay. Really appreciate it. And take care of yourself in India, please.
Thank you, Simon, and you have been patient with all the internet equipment.
No.
Hopefully, you also be safe and the family safe.
Thank you so much. Thank you.
Thank you. Thank you.